Good morning, everyone. Thanks for joining early. We'll be starting in 2 more minutes. Well, hello, everyone. Thanks for joining us today. Hope you all are having a good morning. Today, we shall be talking about compensation analysis, a very hot topic currently. But before we talk to our presenters, I'd like to go through a couple of housekeeping items. As you can see in front of you, there's a webinar pane. If you like to maximize or minimize the pane anytime during the presentation, you can use the red and orange arrow buttons. Also, we encourage you to ask lots of questions. In the webinar pane, you'll see a question box that you can use to type your questions in and click submit. Our presenters will answer those questions as time allows during our Q&A session at the end of the presentation. Also, to ensure good audio quality, please check your setting to ensure the appropriate audio option is selected. If you're using a telephone, please click on the phone call audio option, or if you're listening through your computer, then please click on the computer audio option. If you're looking to get CPE credit today, you must do the following. Use a personal computer, no smartphones, and log in with your own information and unique URL. Be logged in our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. Actively respond to at least 75% of polling questions. We have 5 questions that are spread out throughout the presentation, and complete an evaluation survey at the end of the webinar. And lastly, this is a question we get a lot. Will we be getting the slide deck and recording of the webinar? The answer is yes. You will receive a link to download the slides and the recorded presentation within 72 hours. So look out for that in your inbox. So who are our presenters for today? Well, we have Shannon Oswald. She is a director of our outsourced finance and accounting HR solutions group here at Armanino. Shannon has more than 25 years in experience in HR work, and she has a wide range of clients in different industries, including technology, entertainment, professional services, manufacturing, and private schools. Her area of expertise include employee management, payroll, compensation, benefit administration, and compliance and risk management. We also have Jen McCabe, who's a partner of our outsourced finance and accounting group. She has more than 25 years of experience in our outsourced finance and HR services, with a particular expertise in startups and the advertising and creative production industries. She is passionate about seeing companies utilize the latest accounting and HR technology to maximize their efficiency, productivity, and ultimately success. And with that, I'm going to hand it over to Jen. Take it away.
Okay, everybody. First, we'd like to know, just for our own sake, how many of you have been involved in a compensation analysis before? Please let us know if you've done it. Select yes, no, and it's fine if you select you don't know what a compensation analysis is.
We'll be closing the polls in 3, 2, 1. All right. So we have 54% of people saying they're not involved in a compensation analysis. 43% say yes, and about 3% said they don't know what it is.
Okay, great. All right, so let's move on to the learning objectives, because at least half of you will need to know all of these things by the end, I hope. So I want you all to know by the end of this hour what a compensation analysis involves and how it actually helps you. We're going to give you some common scenarios where CFOs and HR executives find value in this sort of work. We're also going to let you know about some compliance issues that occasionally come and bubble to the top when we're doing a benchmarking survey. And we're going to give you 2 real-life examples, a small company and a big company, and talk about how we use the data in these surveys to come up with a strategy. Okay, so get ready, everybody. I'm going to start with the definition of a compensation analysis. It's a tool, and it ends up in report format, and it's used to incorporate a strategy and a philosophy. And Shannon likes to use the word philosophy because so much of compensation is about culture, which is about philosophy for the company. And when you have that, you can adjust compensation according to the business needs, the business goals, or the available resources, or all three of those. And the compensation analysis, bottom line, compares current salaries that you're paying your staff to what the job market is in your industry and your area. And it gives you the data on a company level and also an individual level. Okay, so Shannon, help me out and describe the deliverable so that people listening can picture what the deliverable is when we do this kind of work.
Yeah, absolutely. Good morning, everyone. So the deliverable that we're talking about for a basic compensation analysis is usually in a spreadsheet format. And what it's going to do is list your employees that you have and the jobs that they're in. And we will collect some census information. So what's their current salary or hourly rate? What's their current classification that they're in? Are they exempt? Are they non-exempt? Are they paid salary, paid hourly? It will also then we take into account their hire date and some other basic information that may or may not affect their pay. And then we look to the market data to pull a minimum, a midpoint, which is really the market average for the position, and a maximum. And within that, we then compare that midpoint to the position to the actual salary of the employee. What that gives us is what's called a compa ratio in the industry, and it's really a position to market for the employee's salary. So a quick way to provide an example of that is to say if the market for the position is $100,000 and the employee is paid $90,000, they'd be at a 90% compa ratio. So that's a quick way to provide a visual as to where that employee sits to market.
Okay, so if a person making $100,000 is at the mid-range, and the mid-range is $100,000, they're at 100% of the mid-range.
Mm-hmm.
And you just present that to everybody and they go, okay, this guy is less than 100% and this gal is more than 100% and they have the same position, and now I know where they compare to each other, right?
Yes, it's a way to do a comparison, and it's also a way to provide a building block for further analysis if you then want to take that data and you want to cut it. So you really want to look at, say, comparing it to the tenure in a position, and you can also filter it by geographic area or something, and you can really see then if any of those factors are affecting how people are paid. And then once you have that information, you can determine whether that's appropriate or not, or whether it's an issue, or there's a whole lot of things that come to light throughout looking at the data.
Yep, I've done it with you. Sometimes there are some shocking revelations. Okay, so let's move on to our second polling question. Heads up, everybody, if you want credit for this. A comp analysis is based on, and you want to select one of these, the business needs, the company goals, the company's available resources, otherwise known as cash, or all of the above. And we go into these analyses often knowing why people want to do them.
All right, we're going to be closing the poll in 3, 2, 1. Here are the results.
Okay, good. Folks are paying attention. All right. Okay, so I think that most of us know logically and intuitively why a compensation analysis is useful. What is interesting is that we've discovered over time that anyone who has anything to do with compensation can benefit from having this information. So before I talk about CFOs and HR execs, this data can also be pushed down to heads of departments or supervisors who are dealing with an employee who comes in and says, hey, I went online and I did a bunch of my own research and my friends are making more money than I am. It can really help supervisors become better leaders and have really strategic answers to some of those awkward questions. At the highest level, the way that Shannon and I have worked together for years is I've been the CFO and she's been the HR exec. And for a CFO, it's clearly a help for budgeting. And so at the end of the year, the beginning of a new year, when I'm helping our clients set budgets and forecasting goals, we have to set aside a certain percent at the company level. So for a CFO, it's often a more global issue. How many dollars am I allocating to my raise pool and my bonus pool this year for 2019? And sometimes that's driven by the company's ability to pay. So it may just be, look, we've only got this much money. And that does happen. And a lot of times at the global level, there's just a number that you've got to make things fit. At the HR level, Shannon will take that with me and say, okay, great, Jen, that's the number. Now I got to figure out how the company compares to market, how individually people compare to market. And as an HR executive, she can help me strategically use those limited dollars to reward the people who need to be rewarded. Because going back to the CFO, the budgeting process involves keeping people from leaving, because retention is key to keeping a control on your costs, and you don't want to have regrettable turnover. So Shannon can help me with a strategy, and we help a lot of CFOs and a lot of HR people determine what strategy they're going to use to keep certain people. And interestingly, sometimes we identify people who our clients have to understand that it might be okay that they don't get a huge increase and they actually leave. So there are circumstances where that's actually the outcome. Shannon, do you have any other things to add there that I've missed?
Sure. So I think when after we complete the compensation analysis, you can really use it, as you were saying, it's a tool to move forward in the process of looking at compensation as a whole for the company. It can be looked at company-wide. So we talked a little bit earlier about philosophy. You can look at it and say, okay, our goal for compensation is to be a leader of the market. Our goal for compensation is not to be a leader in the market. You depending on the different scenarios with your company, you can decide where it's appropriate for you to be. You can use the analysis as a budgeting tool to allocate your entire salary increase pool. You can also use it to talk to your managers and those folks who are going to be determining salary increases for individual employees, to talk about what's reasonable for them and to give them a guideline as to what really is the best way to allocate that pool of increased dollars. You can set expectations in that way to management and also have them communicate that to the employees that they're overseeing, or you can decide to manage that in a different way, but at least you have the information at your fingertips. The tool also gives you guidance on each individual, because remember, we did this on an individual basis. So now we have that comp ratio number for each individual person who's being analyzed at the company for their compensation level. And you can apply that to have a really insightful vision into a strategic way to allocate your dollars.
Right. So recently, we've had situations where the benchmarking survey led a company to issue guidance to all of the leaders who do performance reviews, so that they could intelligently answer people who said, hey, when is my next review? They could say, well, are you talking about performance or are you talking about compensation? And if people said, what is the percent that this company traditionally gives out? Then the supervisors could answer, well, we always give 3% cost of living. Or they could say, we have a compensation committee that meets several times a year. Whatever it is, this outcome, this deliverable, results in companies answering in a politically savvy, strategic, and culturally on point way. Okay? And it's hard. These are difficult conversations. All right, let's go to the next slide.
Okay, so for this one, we want to look first about when companies really need a compensation analysis. There are some companies out there that just automatically do an analysis every time a person changes roles at a company, or they do it on an annual basis, especially if they do some kind of simultaneous increase process, or if they look at their forecasting for the next fiscal year all at one time. There are plenty of companies that don't do that. So if that's not something that you're currently doing, it's not that you're behind. It's just another thing that you could add to your toolbox if you decide that's something useful for you. If a company finds itself in a position where you're looking at a fixed budget for increases, or specifically if that budget is a little bit tight, you'd like to be able to offer more, you feel like maybe your employees are underpaid compared to market, or you've gotten feedback from employees that they feel like they're underpaid, that's the time when you really want to look very closely at your compensation and take away that kind of arbitrary feature of it and really treat it more like data, and take out the emotion of saying, yes, this person should get a raise or this person shouldn't get a raise, and really look empirically at what the numbers say. If you have that sort of analytical facet to your application of those increases, you'll be able to really approach it in a logical manner, and in some ways you'll see where someone you may want to give extra dollars to versus someone else. If you have a lot of tenured staff, as I was saying before, I talked a little bit about hiring date, you want to be careful that people who are with a company for a long time don't experience what's called salary compression. What that is when the increases given to an employee are not keeping up with the external market of increases for that job. So in some cases, if you have a problem with compression, you'll find that your new hires that you're bringing in are being paid more than the people that have been with the company for a very long time. And in that case, you're seeing where the market is demanding that new hires are asking for a certain level. Your current employees may not have that luxury to require that level when they have their annual reviews or when they get their salary increases. So you want to be sure to take care of and treat everyone with a parity when you look at their compensation.
Hey, Shannon,
Mm-hmm.
let me interrupt you for a second. When you're talking about tenured staff, we have also seen the opposite, right?
Okay.
Where we've had, and this is a difficult conversation sometimes, where you have a company that's been in business for a while, and everybody, just because the company's philosophy is this, has gotten a 10% raise every year since they got hired 10 years ago. And in that case, what's your advice?
So my advice in that case is still to go back to the analysis and compare what they're making to market. So instead of having a philosophy where you give everyone a flat raise every year that might be too low, might be too high, really go back and look at what their current rate is and see, are they at 90% of what the market is paying? Are they at 120% of what the market is paying? And in that case, you'll see, should I give them another 10% raise or should I not? And there are other components that we consider, obviously, when we're talking about increases, specifically performance and key employees. So if that person's a superstar performer and you feel like it would really impact your business if you lost them and you want to keep them happy, you could consider continuing to give them an increase. You could consider, instead of giving them a base salary increase that will increase your overhead year over year, you could give them some kind of a cash bonus in lieu of a base salary increase, or you could get creative and start to think of some other ways to really provide a total rewards experience for your employee. Sometimes adding benefits like a parking benefit or adding cell phone reimbursement. Look at the overall benefits that your employees are getting. not just including their cash compensation, their bonuses, maybe they have equity packages, but also look at other ways to come up with things that are consistent with your culture at your company and that also provide something of value to employees.
When you say we should consider equity compensation, we obviously look at that a lot. We have a team here at Armanino that looks at equity comp, does cap table maintenance, and how does that play into salary compensation, cash compensation? How do you see equity rewards playing into that?
I think that they have a very symbiotic relationship. If you are talking about equity, it's a form of compensation. It's not really considered liquid cash that you can go out and spend until you exercise that equity and convert it to cash. But quite often you'll see an equity component that's partnered with a cash component for kind of an overall comp package. Same thing with bonuses. You'll see where someone might be offered a base salary and then offered a bonus as an add-on to that. The bonus is considered maybe non-guaranteed pay, but certainly there's a plan, usually with thresholds or some kind of goal they have to meet to get it. Equity is usually something that's granted over time, so it's different than cash. It's actually a component of compensation that can be used for retention, given that there's a vesting schedule that goes along with it. And actually, at Armanino, we partner a lot with that equity group to work on projects or packages or offers that include both of those features.
Okay, got it. And I'm sure that the equity comp discussions revolve around how liquid the equity actually is and how vested the employee is and how important it is to retain that particular person using cash and or equity. So that's a really strategic conversation. That's a lot of fun. I love those conversations.
Right.
Okay, let's go to the next slide, unless Shannon, you're dying to say something else.
I think we're good.
Okay, let's do another polling question to wake everybody up. And who's going to use a compensation analysis as a tool? Anyone influencing comp decisions, only CFOs, only financial professionals, only HR professionals. These are mulligans, you guys. Everyone should get that.
Remember, if you want to qualify for CPE, you need to answer this one. All right, we'll be closing the poll in 3, 2, 1. Here are the results.
Okay, good. Most of you are paying attention. These tools have to do with payroll and pay. And so just about everybody is at least curious about the results. And hopefully the people who are most curious are the people who can use the data in their jobs in making decisions that help make a company successful. Remember, the ultimate result of this data is to make the company stronger and better. It's not just to address employee or CFO or HR people's issues or their personal issues. A lot of times pay is very emotional, but this is a way to make pay not so emotional and way more strategic. So those are the folks who should be using it. When we're doing these surveys, the first thing that we do is get census information from our clients' payroll and HR teams. Sometimes those payroll and HR teams are us because we do that service here. But when we're partnering with other companies that have their own back office, they have to provide us with a bunch of data. And we plug that data in. And in the process, some things come to light sometimes. Some things just sort of bubble to the surface that have been lying there hidden. And many times for years, well, policies have changed or statutes have changed and they need to be addressed. So Shannon, go ahead and take us through a couple of the really common things that come up.
Right. So when we're looking at this analysis, we're going to look for things like we've already talked about, salary compression, where employees are to market. So if an employee looks like they're very low compared to the market, you'll realize, oh, okay, I have an issue of not keeping this job current or not offering enough for this job. And what you find is that it's difficult to retain and attract the best talent for that role if you're not paying it correctly, or if they can go out and easily find a position at a different company doing the same work for more. It'll be difficult to have that, convince that employee to stay with you. So these compensation analyses can really help with that issue. The other thing that you can look at, you see the list in front of you here, things like pay parity. So once you have the analysis done by individual, you can sort it by job and you can say, okay, I have 10 people in this role and the range that the market says is between this number and this number, but you can also look at your internal range and say, okay, so for this same job, I'm paying people from this amount up to this amount. And is that appropriate? Is the range appropriate, or is it too big? Is there too much space between what your lowest paid person versus your higher paid person in that role is making? If so, you need to make some adjustments. Also looking at the skill set of those people in those roles. Is your highest paid person your most highly skilled and most key person for that role? Is your lowest skilled person maybe the most entry level person who's still learning the role and getting up to speed? If not, you can say, okay, it looks like maybe I've got some issues in here that I need to at least consider when I look at my increases this year. The other thing is,
Let me jump in there for a second, Shannon.
sure.
You have shown me this before, and we've been with clients looking at the data, and we've had two interesting results. In one case, someone said, yeah, I have a revolving door and I don't care. It hasn't affected my business at all. So I think that staying below market is just fine for me. I don't need highly skilled workers in that job. And if everyone else is paying more, shame on them. That's why I'm making better margins. That's always an interesting outcome. And the other one is when an employer says, gosh, I thought everyone in that area of the company was super happy and that's why they weren't leaving. And now I see why they're so happy. It's very illuminating.
Yes, absolutely. The other thing that comes up when we start looking at this stuff is compliance information, which especially in the state of California, but I will tell you it's coming up in other states as well. There are certain wage thresholds that folks need to meet. So the whole question of how you're assigning your worker status of being exempt or non-exempt from overtime, just having that list and seeing how people are paid will help illuminate that as to who's kind of sits where in your organization. But also, even if an employee is, or I should say rather the job role is classified as exempt from overtime, there are still wage thresholds for that to apply. So if someone has a job that's completely qualified as an exempt level role, but they're paid below the salary threshold that is required in that region, they cannot be considered exempt from overtime because of that salary threshold. So then you have the choice of either bumping their salary up above the threshold or starting to pay them as a non-exempt worker until such time as they get to that threshold. So looking at the list.
How often do those thresholds change? Realistically, how often do thresholds actually change?
Realistically, in California, there's been a lot of movement over the past 5 to 10 years. You'll remember back in was it 2, 3 years ago, there was a big initiative to change it at the national level that was stopped at kind of the 11th hour in a Texas court. But there have been changes since then, and there have been several changes within California. California is interesting because our threshold for exempt level work is based on 2 times the minimum wage for the state. So every time the state minimum wage changes by any amount, that exempt level threshold changes as well. And as you know, California has been on a progressive minimum wage increase every 6 months to 1 year for several years now. So we've been seeing many changes in that area.
Right. So folks who were at the threshold 18 months ago and maybe got a raise may very well not be at the threshold today.
Mm-hmm.
Okay.
Yes, very much so. Another really hot topic is the classification of workers. So when I'm talking about that, I'm talking about both exempt or non-exempt, and I'm talking about 1099s versus W-2 workers. The 1099s are not going to be on your compensation analysis
But
because
people
you're really
give
going to
them
look
to
at
it.
that.
That's the
Yes,
scary part. When we ask for the census, we see people say, oh, and I want to include my freelancers in this. Or they'll say, oh, and this person I gave a W-2 and it looks really low, but just so you know, I also give them cash comp and I 1099 them for that part of it. Those things have been said out loud in our presence.
Right. So that's another thing that we're really going to look at in these analyses is, do you have two people in the same job where one gets overtime and one doesn't? It might be okay if you've got that salary threshold in there and one's below it and one is not, but it's probably not okay if they're both above the threshold or both below the threshold in the same category and they're being paid in a different fashion. That's a huge red flag for us. If we see that you have included 1099 workers in your census and you have some 1099 workers that are doing the same jobs as some employees, another huge red flag. For one thing, if they're 1099, they're probably not going to be doing jobs that you're actually hiring people for. And two, if you have people doing the same work, they should be classified in the same way, and you want to make sure that classification is correct. So and I will also say if you're including them on your salary survey with your employees, you're probably treating them like employees in other ways, and that's something that we need to talk about.
Mm-hmm.
Underpaid internships. Interns are really treated like employees, and there are some instances in which you can have unpaid interns. However, both the state of California and several other states and the federal government have guidelines as to when someone can be unpaid, and they are not as wide as many people think. The concept of just bringing in an intern for the summer to get some work done and, be some low-cost labor for you while the student is learning and increasing their experience is really not enough anymore. There really needs to be an educational environment. There needs to be time spent with that person in an educational capacity. Really, even if it means that the company is in a detriment, it's costing the company money to have that intern come in. So not only are they having that person maybe not do productive work for the company, they're also having to spend time to train the person and give them educational opportunities. So, that's kind of the level of the unpaid intern at that part. So if any of you have questions about that, you can talk to us. You can also look online. There's a lot of information about those checklists that you need to meet for unpaid interns. So if we're looking at this analysis and we see people are unpaid, we're going to say, you're really incumbent to at least pay minimum wage for that person. So even if for interns, we're not typically looking at a market analysis, but we are looking to make sure that you're at least compliant with minimum wage and other wage and hour guidelines that you need to stick with.
Right. What we see there is people will say to us, well, I'm just going to give them a stipend. And I'm also going to reimburse them for their expenses, their mileage. And we see people doing funny stuff. They say, well, I'm going to give them a $600 a month stipend. The kid lives at home. And we're also going to reimburse them for their commuting miles to and from the office. And that, of course, is not tax deductible. The commuting is a problem for tax. But then the stipend is interesting because it probably isn't enough. It probably isn't minimum wage, although it might be. It depends on what this person is actually doing and how often that they're at the office. But when we get audit notices from the EDD, and a lot of those come to our desk from the EDD, and they might be an unemployment claim, or most often these days, every day, we see one of our clients getting an audit of their 1099s. And one of their first questions is, do you have any interns? And if the answer is yes, they ask to see the educational paperwork from the institution, or they ask to see the 1099, which is always a problem if you have a 1099 for an intern, because they never qualify to get a 1099. They always should be on payroll. And if you show them the payroll report, they ask to see a timesheet. And this happened to me twice in the last 2 weeks. So in a benchmarking survey, we would see that, and we would warn you and say, okay, wait, let's double check this one and make sure we are fully compliant.
Right, and that kind of brings us, it's a good segue to our last bullet point here, that those wage and hour requirements, they do apply to all employees. And if you have non-exempt employees, or otherwise known as hourly employees, who are eligible for overtime, they need to be paid hourly. So that concept of a stipend, even if it's over the minimum wage, it's difficult to apply that to an hourly worker. And the hourly worker might come back and say, I actually worked overtime for those days and I need to be paid for that in addition to my regular time. So that concept of like, I'll just pay you $500 a week and that meets the minimum wage and you'll be fine. They're going to say, no, that was for my regular time, but I worked 10 hours that day, so you owe me additional time and we need to convert that to an hourly rate to get my overtime. And if one employee calls that to the attention of any kind of an auditing organization such as the EDD or something like that, you're going to be looking at basically an audit of all the people in that role, or perhaps all the hourly employees at your organization. We do get those kind of things come up. So they can turn into larger problems very quickly. And I think one of the pitfalls is employers thinking that it's not that much money if they're making minimum wage, so they don't pay as much attention to it. But it can really grow. It can grow in the amount that's owed, and it can also start to stack up penalties. So I want to be very careful with that.
Yep, and they go back several years too.
Mm-hmm.
So it's just, and you spend a lot of money on people like us helping you get out of that pit. All right, let's go to our next polling question. When you do a comp analysis, you're satisfying the new requirements in 2019 for sexual harassment prevention training. Let us know if you think that's true, false, or if you have no idea.
Just a reminder, everyone, if you're looking for CPE credit, please make sure to answer this question. All right, we will be closing the polls in 3, 2, 1. Here are the results.
False is the correct answer. There is a lot of new legislation in 2019. There are many new rules effective in January, several of which point to sexual harassment prevention training. But a benchmarking survey is not going to help you with that particular issue. That's a different phone call for us, guys.
Yep.
Okay.
And just to kind of round out that, in case anyone's wondering, the new regulations for 2019 are that by January 1st, 2020, companies in California, in the state of California, with 5 or more employees now need to be providing sexual harassment prevention training to not only their management and supervisory staff, but to all employees. There are different levels of training that are required, but that's something new. The threshold used to be 50 or more employees, and now it's down to 5 to have to take action. So that's also something that we're working on quite a bit this year.
Yep, and it used to be that you had to talk to people who were in a supervisory position, but now it's everybody. So unless you have a company with less than 5 people, it's pretty much going to apply to your team, and everybody's trying to get that done by January 1st. It's not an emergency yet, but we do need to try to make sure people are doing that. All right, so now we want to make it real for you guys. And I'm going to kick it over to Shannon. We want to give you examples from what we've done in the last couple of months. We want to give you a big client example, and we want to give you a small client example. so that you understand how useful this tool is, regardless of the size of your company in certain cases.
Okay. So when we were preparing for this slide, we really talked about, should we talk about a really large company that we've worked with? Should we talk about some of our smaller ones? You can see here that we couldn't decide, or we decided that actually both are really useful for you to hear about. One of our examples was a larger client that we worked with who they really didn't have a process for their performance reviews or for their merit increases that they did. Performance reviews were limited to, continual feedback from management. It tended to be for those maybe with performance issues. They would sit down with their employees and talk to them if there were performance issues. However, they weren't really doing an annual review process or even, or anything like that. Employees really connected getting a performance review with getting a raise. So what they said when they came to us was they were concerned that if they announced they were going to do performance reviews, everyone would just say, oh, great, we're getting a raise. They had a lot of employees, when we looked at the census data, it was actually something we see very common for a company that isn't maintaining current benchmarking analyses for their data. It was kind of all over the place. They had employees that were way under, they had employees that were way over. There was probably a reason why that had happened over time, but no one was minding the store in that capacity. So we saw a lot of fluctuation. And what we did was apply market data first off. That was our go-to thing. First, let's look at where are the variances and how big of an issue are we really looking at? Is it a couple people? Is it all of the staff? What are we looking at here? So they went from having no market data to having fresh market data to look at all their positions. In that case, we were able to set an expectation, as we talked earlier, with the employees to come in and say, okay, you know what? We are going to start doing performance reviews, but we're going to start doing them on a quarterly basis, and it's just going to be a conversation with you and your manager. These, in reality, were already happening a lot. Managers were talking to their employees, maybe on a quarterly basis, maybe not regularly, but they were working together and there was feedback sessions going on. So we said, we're going to formalize that component of it and manage your performance. It doesn't mean you're going to get a raise every time you sit down and talk with your boss. We're going to do an annual salary review, which includes wages for everyone, whether they're paid salary or hourly. We're going to do an annual review of what we pay people, and we're going to apply this market data to do that. And then they found that in order to correct all the issues within 1 year, it would cost way too much money than they had. So the other thing we did was cut it down by who are your star performers and key employees? Who are the people that you absolutely cannot lose, that it would have an impact to your business if you lost them? So we kind of put them in one category and said, okay, those are the folks we really need to take care of in this first pass. Let's look very carefully at their compensation and figure out how we can get them as close to market or as close to what's appropriate for them as possible. And then we looked at other employees in the same pass, but we were able to prioritize and kind of triage different maybe flight risk employees or people that they really felt were in a situation they wanted to address it right away. So we were able to really focus in on that, and it was such a more strategic approach than doing what I call like a peanut butter merit increase, where everyone kind of, you have your money and you spread it all around kind of evenly over everyone. It doesn't solve your problems. It just sort of magnifies them. Your overpaid people are still overpaid. Your underpaid people are still underpaid because you weren't really able to allocate enough to them to make a difference in the situation. And everyone kind of walks away from that feeling the same as they did before, but you just spent a lot of money to get there. So I would recommend doing a much more thoughtful analysis, putting your money where it gives you the most value for that, and and really addressing some of the salary issues that might be existing at your organization.
Now, that particular assignment was interesting. A lot of what you did, as I recall, was driven by employee dissatisfaction. People
Yes.
were demanding increases. And then when you walked away from it, what was so interesting was we did the benchmarking survey and came out of it with a more structured performance appraisal plan, which I, as an accounting girl, loved because it was about making people get performance feedback quite often, and it separated the performance feedback discussions, which needed to happen a lot, from the merit increase discussion, so that employees did not expect at every juncture, every conversation, to have a salary adjustment. It made them also, that both the employee and the supervisor, more liable to talk about performance more often, and performance increased. And also, would you say at the end that employee satisfaction at the job increased there?
I would say yes, because even for those employees that may not have experienced as large of an increase as they had wanted due to budget constraints, at least I think that it really increased um, the accountability at the executive level, and employees noticed that. They were able, and we did actually get feedback from employees saying at least they're looking at it and we can see that they're taking actions. And it really added to the credibility of the executive team.
Right. Who also, by the way, this executive team, I think, thought that they were allocating most of their dollars to the most critical people. Most people do. They think they're already rewarding people before they become a flight risk if they're valuable. But the data is super informative because it either confirms or denies your assumptions.
Hmm.
Okay.
Yeah, absolutely. Okay, so then going on to our small client. Um, Small client, this example was a little bit different. You can see there we talked about hybrid jobs and difficult survey. What that means is, in a large company environment, there tends to be very defined roles and there's staff to fill those defined roles, and there's enough work for one person to do one job for 40 hours a week. When you talk about a small company, think about hybrid roles where somebody might be an office manager and in charge of accounts receivable and accounts payable, and they might be the executive assistant to the founder of the company. So when you're talking about benchmarking, which job do you use? Is the job simply an average of the market for those three positions? Probably not, because some of those roles, especially something like that, those can be real cornerstones of the business. So it becomes difficult to apply that type of a job to a benchmarking survey, um, because you need to take into account that sort of, priceless factor of someone in a role like that. There are other roles at small businesses where they combine roles because there may not be enough business to do 40 hours a week in one job. People might end up doing two. There might be plenty of work to do 40 hours a week in one job, but the company just can't afford to hire two people. Small startups, companies of small stature, they do tend to have people wearing multiple hats. So that's something you need to take into account when you look at these benchmarking surveys. And it really means you have to go back and really talk to the management staff to make sure that whoever's doing the benchmarking understands those kind of features.
Mm-hmm.
In this case, it was a very tenured staff. There were people that had been there a long time. There was obviously some compression. There were people that were overpaid or underpaid. And what we were starting to see at that company was turnover, either low turnover for the people that had been there a long time or that were way above market. They're not going to leave. They're paid way above market and they've worked there a long time, and they were comfortable. We had higher turnover in some of the entry level positions or some of the people that hadn't been there a while. They would come in and find like maybe the salary wasn't really equitable with what they could find somewhere else. So that company was bringing in entry level folks, spending a year to train them, and then they were leaving to go somewhere else because the salary just wasn't where it needed to be. Some of the folks hadn't seen increases for a very long time. And another thing that we see sometimes in small businesses, we also see this in large businesses too, people with authority over the budget have their own opinions as to who deserves an increase or who doesn't. And so there's sometimes a factor of arbitrariness in how increases are allocated. Salary survey can take out that question and really, again, pull you back to sort of an empirical review of your data.
Yeah, and it takes, in a small business, many employees will have access to the owner. And in a small business that's been around a while, they may have very intimate relationships with the owner. The owner knows if they have moved into a new house or had a new baby. And so we will see places where an owner is giving raises based on lifestyle changes rather than based on the position or the work. And so you see two people, they're in the same position, and a small business owner will out loud say, yeah, but that's because, you know, this person has a large family and this person doesn't. You know, you got to think about those kinds of answers to determine whether that makes sense or not for the business, and try to rope it in. And in small businesses, people are so emotionally attached to each other. Again, it does help to have some data so that you don't feel guilty about the decisions you make based on pay and merit and increases or bonuses. That's a really important thing. We have seen in this, I've seen it many times, where small businesses will give a bonus to someone who's just had a child. And you can imagine that that doesn't go over well with the non-childbearing staff. So all these things come up in small businesses. They're really interesting because they have a lot of hair on them. A big client is more likely to be less personal, of course, with hundreds of staff. So in each case, what comes out of the discussions with the executive teams are fun and interesting problems. And they're all different. Every client is different. Let's go to polling question number 5. I don't know if okay. Let us know if you're planning on doing a compensation benchmarking survey or any sort of compensation analysis, and we will use that data. Helps us know if we're doing good work or not. And then we're gonna give you a few minutes for that and move into some questions.
This is our last polling question, everyone. Just a reminder, for CPE, you need to answer this one. All right, we will be closing the polls in 3, 2, 1. All right, here are the results.
Okay, that's interesting for us to see. 65% of you say, yep, you're going to do one of these comp analyses. They are useful. They generally are useful. You're speaking to me, Jen. I had my own little company. I only had 40 to 45 people at the end, but we use it, and we use it here for teams of 15 or less sometimes. And again, the data is very useful unless you aren't going to give raises at all. That's when you really don't care because you just don't have the dough, period. In that case, maybe it's not so useful, but you might want to know who is a flight risk, who you might lose. Okay, Shannon, one of the questions that I saw was about the case study, the big client that we had, and people are asking how many employees did that client have and how many do you think were affected by the pay raise?
Affected by the pay raise, I'm assuming that means how many people got a pay raise out of that population. I will say that employer had several hundred, and we probably looked at the top, I would say 20%.
Okay, wait, that was 700 employees at that one, I believe. And 20%? 20%? Okay.
Yep. So we looked at about 100 employees, give or take. No, I'm sorry, 150. That was right. It was about 20%. So we looked at about 150 employees as the ones that we felt were in that category of in a position where that's where we wanted to focus our dollars. It doesn't mean that no one below that list got any increase, although some of them didn't. And I would say the majority of the cash went to the top 20% in a strategic move to kind of look at, again, like you used the term, flight risk employees and people they felt really needed an adjustment to have that be more commensurate of their contributions.
Okay, so like I did the math, 150 out of 700 people is 21% of the people got most of the money. So that's a pretty strategic allocation versus the peanut butter, everybody gets the same percent, or you guess based on what you think. And Shannon, another question is about addressing workers in other geographies, which is a key element of these surveys. People are saying, well, what if your staff is spread out in various locations? They have the same title, but they're in different geographies.
Yeah, we have a couple of projects going on right now with that exact kind of scenario. It can be very impactful if you live in, New York City or the Bay Area, California, compared to an employee doing the same work, in a different area with a lower cost of living or something like that. There are some key geographical areas that really affect compensation levels.
Yeah, that's
Um,
why you guys, companies have offices in other geographies, frankly.
mhm,
It's
mhm.
it's it's why jobs are leaving California. You can have the same title here and have it in Nevada and pay a person doing the exact same job significantly less dough.
Right.
My last
So
one, Shannon. Oh, sorry.
Oh, I was just going to say it is a way to justify, there isn't a rule that said you have to pay people the same if they're in a different area. It's another feature to consider when you're looking at pay. Obviously, you want to consider things like the Equal Pay Act and other pay equity guidelines that employers need to look at, but you can certainly consider geography as one of those things and then determine whether it's appropriate or not to apply it.
Right. And then we had a couple questions on how we figure out what survey we're going to use and what surveys we go to. I know we use the Radford sometimes, but I've
hmm
seen
hmm
I've seen you use several.
Right. So, there's a lot of different surveys out there, and they can be available for a small amount of money. They can be available for a lot of money. You really need to look at it to see where you're going to get the most value. So, if you want to use a consulting service that has surveys available that they can, you know, they charge you a fee for their service, but it includes access to that survey data for your project. That's one way to be able to use some of the larger surveys without having to pay for them yourself. Um, some of those smaller surveys can be very powerful though, because they're very specific to industry.
Mhm.
If you really want to look at one industry in and sometimes in one geography, you can find a survey for maybe not a lot of money, but it's right on the money for you. So I like to be very agnostic about what kind of survey we use and really think what makes the most sense for this project.
Right. So people are saying, how do I get my market? How do I get my titles? Part of this project is finding the right survey and determining if you need one survey or more. And so there are times when you do benchmarking. I've seen you do it using 3 surveys for one company because they
Mhm.
have varying staffs or varying locations. So there's a bit of a judgment call here, and Shannon has a specific education in compensation analysis. So that's why I always ask her all my questions. And my last one for you, Shannon, is how often should people do benchmarking?
Well, I would say um, a really good standard for looking at your benchmarking is once a year, and it probably goes hand in hand with your budget forecasting. So as you come up to your next fiscal year, you want to take a look at your benchmarking and see where you are to market and, you know, to get where you want to be, whatever you've identified your philosophy at, to get where you want to be for your employees, is it that you just need to budget for a cost of living increase this year? Or do you see that you have some key areas that you need to address and you need to forecast some more money for those raises? So that can be a very effective tool to work hand in hand with your accounting department and say, okay, for salaries, here's what we really think we need to do to remain competitive and to attain and retract over the next fiscal year.
Right.
So,
And I see us getting asked more often when it's an executive, when we get these tricky questions where someone calls us and says, look, I just need to know if my COO is being paid the right amount of money. And then it's more than annually because it's an individual kind of question.
right.
All
And some companies don't do it annually. And, that's okay too. One kind of trick you can do if you don't want to do it annually is you can find out what's the average market increase for either your industry, your area, or just use the national number and say, okay, overall, we think that salaries are going up about 3 to 4% this year. So I'm going to increase my budget 3 to 4%, or assume that all of these jobs are going to go up 3 to 4% this year. And you can kind of keep an eye on it that way, kind of mind the store, like I said before, but without actually doing a full-fledged analysis project every year. But certainly if you want the most accurate and insightful look at your data, do it, on a regular basis.
right. Okay. I think that's it. Sarah, we are out of time. Please know that if you wrote us a note, we will write you back.
Yes, and we've been getting questions on when we will be getting the slides, if we're going to get the recording. Again, the answer is yes. All participants will receive an email within 48 hours with a link to the slide deck and the recording, so keep a lookout for that. And thank you so much, Shannon, and thank you, Jen, for joining us today, and thank you, everyone, for taking your time for our webinar.
Thanks, everybody.
Thanks, everyone.